Most beginners think technical analysis is about finding the perfect indicator. MACD, RSI, SMA, EMA, the alphabet soup. But professionals, they focus on just 4 simple concepts that drive the entire market. Today, I'll show you the core technical analysis skills every trader must learn before they ever worry about indicators. Master these, and the charts finally start making sense. Indicators are not magic tools. They're just mathematical translations of price. Meaning this, price moves first, indicators react second. If you want to understand the market, you must learn to read raw price action. That starts with the 4 pillars: trends, support, resistance, volume. Learn these, and you'll understand 80% of the market's behavior. A trend is simply the direction price is moving over time. There are only 3 uptrend: higher highs, higher lows; downtrend: lower highs, lower lows; sideways, and a price ranging between levels. To draw a trend line, in an uptrend, connect the lows. In a downtrend, connect the highs. Trend lines help you understand where buyers repeatedly step in, where sellers repeatedly take control, when the trend is weakening, when momentum is shifting. Here's the key rule: never trade against the trend unless you're experienced. The trend is your friend, and beginners ignore it at their own risk. Support equals a price level where buyers repeatedly step in. Resistance equals a price level where sellers repeatedly step in. Think of support as the floor and resistance as the ceiling. Price bounces between these levels because traders remember these areas. Institutions place orders there. Market psychology repeats. Supply and demand shift dramatically. Support and resistance are the backbone of entries, exits, stop loss placement, breakout trading, reversal trading. Here's the key insight: support and resistance are zones, not perfect lines. Beginners get frustrated because price breaks by a few points. Professionals see that as normal market noise. Fibonacci levels help identify where a pullback might end before the trend continues. The most important levels are 38.2%, 50%, 61.8%. You don't need to know why those numbers exist. You just need to know this: when price pulls back into one of these areas, it often finds support or resistance and continues in the direction of the original trend. That's why Fibonacci is so popular, because it reflects real market behavior, not random theory. Volume shows you how many shares, coins, or contracts were traded during a specific time period. High volume equals conviction. Low volume equals hesitation. Volume tells you whether a breakout is real or fake, whether a trend has strength, whether buyers or sellers are serious, when a reversal may be coming. Here's the rule: professionals follow. Price moves on low volume are weak. Price moves on high volume are strong. Volume confirms everything. Here's what real trading looks like: identify the trend. Mark support and resistance zones. Wait for price to pull back to a key level. Check volume for confirmation. Look for candlestick signals. Enter with proper risk management. No fancy indicators, no complicated strategies, just pure price action. This is how professionals operate. Imagine price is in an uptrend. It pulls back to a support zone around the 50% Fibonacci level. Volume decreases during the pullback, then a bullish engulfing candle forms with rising volume. That's a high quality setup. You're not guessing. You're reacting to the market story. Now that you understand the essential building blocks, it's time to put them together into a real trading strategy. Most beginners jump straight into strategies without understanding the concepts you just learned. But you're not making that mistake. In the next video, I'll show you how professionals build strategies from scratch and how you can create one that fits your personality and style. Click the next video in the playlist: how to build a profitable trading strategy, step by step. This is where everything you've learned starts to come together.